Hi, I'm Jim and I was retired. Does Grok like the three bucket strategy? I decided to continue my experiment with Grok 3 to explore ways to optimize my DIY retirement portfolio. So come along as I ask, Grok, update my three bucket portfolio. Stay tuned. So here's the way my conversation with Grok began. I asked, optimize the following portfolio. And before I could even provide some asset classes, it jumped in with a response. I'd be happy to help optimize your portfolio, but I don't have any details yet. Could you provide specific assets in your portfolio, such as stocks, bonds, and other investments? Additionally, let me know your goals. By the way, I captured all of this conversation on a Pages document, which may be easier to follow. Grok begins by reiterating what you told it, so let's read. Got it. Let's optimize your portfolio, and it reiterates what I gave it in terms of, and it assumed that the balance was in treasuries because I didn't provide a specific amount for that. Since you didn't specify your goals or constraints, let's assume a common objective, balancing growth and stability for a moderate risk investor with a 5 to 10 year horizon. I'll use general principles of portfolio optimization, e.g., the modern portfolio theory, based on historical asset class performance and correlations, while keeping it practical and diversified. If your goals differ, e.g., aggressive growth or capital preservation, let me know and I'll adjust accordingly. And so it goes through an analysis of the current portfolio. Stocks, decent exposure to growth, but it's a big chunk, higher risk, especially if you're concentrated in one sector or index. Well, in my case, I'm in the full market VTI as my major holding. International stocks, 5.5%. It's a low allocation. This limits diversification benefits from global markets. REITs, 2.5%. Small position, offers income and some diversification, but minimal impact at this size. And in fact, my target is 5% for international and 5% for REITs right now. So there's some work to do in my portfolio, I know. Reasonable liquid cushion, though it drags on returns in a low interest environment. U.S. bonds, 5%, very low in fixed income, limits protection against stock volatility. Treasuries, 28%, heavy allocation to safety, which reduces risks but also caps growth potential. And again, Grok doesn't know anything about my circumstances yet, so he goes on to suggest an optimized portfolio. Here's the revised allocation to provide diversified balance, risk reward, and align with a moderate risk portfolio. And they're just essentially doing it in a close to a 60-40 split here. Stocks 40%, international stocks 15%, REITs 5%. If you add that up, it's a 60%. And the balance in cash and bonds, 5% cash, trimming it down from my current cash position. U.S. bonds, 15%, up from 5%. Use intermediate term bonds, e.g., 5 to 10 years, for yield and moderate risk duration. And 20% for treasuries, down from the current 28%, but still substantial for safety. Focus on short-term intermediate treasuries, e.g., 2 to 5 years, to balance yield and flexibility. And by the way, they're starting to jive with my outlook on the portfolio because I do limit my treasuries to less than 10-year treasuries. I don't have any 30-year treasuries at my age in my retirement. Why this works: risk reduction, lowering U.S. stocks and spreading to international stocks and bonds. And we'll get back to this in a minute. Do you agree with that? Leave me a note in the comments below as you hear this rundown. What strikes you as good advice and AI advice. Hey, before I go any further though, will you please take a moment to like, share, and subscribe to this channel if you like insights from a DIY retiree? Thanks. So diversification, higher international and REIT exposure captures growth and income from varied sources. Stability, more bonds and less treasuries, improves yield without sacrificing too much safety. Growth potential, 55% in equities, U.S. and international, keeps you positioned for long-term goals. And again, REITs is an additional 5% in what I would classify as the stock portion of the portfolio. Expected outcomes, rough estimates based on historical averages, not guarantees. They're looking at a roughly 7 to 9% annualized return for U.S. stocks. International stocks are slightly less at 6 to 8%, moderate volatility. REITs are also 6 to 8%, moderate volatility plus an income source. U.S. bonds 3 to 4%, low volatility. Treasuries 2 to 3%, very low volatility. And again, historically, that may be true. Right now, we're in a higher treasury yield period. How long will it last? I don't know. Cash, 1 to 2%, no volatility. And again, cash right now is earning a little bit more, particularly for cash and cash equivalents, which would include T-bills and CDs. Your current portfolio might yield 5 to 6% annually with moderate to high risk. The optimized version could aim for 5.5 to 6.5% with lower volatility. And again, lower volatility due to better diversification. And again, moderate improvement in portfolio performance, next steps. And it runs through, I'm going to scroll through this a little bit because I then confirm some things for them. Confirm your goals, asset selection. I can suggest ETFs or funds, VTI for stocks and VXUS for international, and in fact, I own both of those. Rebalancing, plan to review yearly or after big market moves to maintain these targets. And now in rebalancing, I actually rebalance quarterly, but only when needed, when it varies away from the target that I'm aiming for significantly. I do it at least once a year because you have to. What do you think? Any adjustments you'd like to explore? Now, it does put out this. Grok is not a financial advisor, and as you've heard me say, I'm not one either. I'm just a DIY retiree. Please consult one. Don't share information that can identify you. And again, I'll reiterate, I'm sharing with Grok what I've shared with all of my viewers on this channel. Something close to what my circumstance is, but not exactly. Just enough so that you can get a sense of where I am as a DIY. And again, I'm married, filed jointly, living in New Jersey, so that colors the story that I can describe to all of you. I just hope some of my lessons here on my DIY journey in retirement can benefit you. So I clarified, I'm in retirement and hold equities for long-term. Cash and bonds and treasuries are held in short-term buckets. I use a 3-bucket approach. Bucket 1 is for cash for 3-year needs, bonds for 4 to 9 years, and equity is in bucket 3. And I've shared my 3-bucket strategy with you all before, and you can find it up there in the corner with my review of the 3-bucket strategy. Thanks for the clarification. Your 3-bucket retirement strategy makes perfect sense. Thanks, Grok. Bucket 1, cash for immediate needs, 0 to 3 years. Bucket 2, bonds and treasuries for intermediate needs, 4 to 9 years. And bucket 3, equities for long-term growth. Again, bucket 3 is stuff that I do not need to touch for up to 9 years. So 10 years and beyond is where I want equities. Since you're in retirement, let's assume your goals are to preserve capital in the short term, generate income in the midterm, and maintain growth to outpace inflation over the long haul. And in fact, that's exactly why I own equities in bucket 3. It's inflation protection. And if you're looking at 30 years of a DIY retirement, you better be thinking about inflation protection with equities. Let's optimize the portfolio with this framework. And it goes on, does a recap of the current portfolio, and starts to map out a 3-bucket strategy that is surprisingly close to where I am. So let's review it. 7.5% for cash, bonds and treasuries, 5 and 28%, so that's 33%. And bucket 3 is coming up to closer to 60%. So it currently is close to the 60-40 that I'm at right now, and I'm aiming, as you know, 70-30 into the future. I haven't told Grok that yet, so let's go through the analysis that he gives of the current strategy. By the way, I'm saying he for Grok because it sounds more like a masculine name than a feminine name. Shoot me. Analysis of current setup. So covers 3 years worth of expenses if it's sized to your annual spending. And again, this is, you got to do it based on your annual spending, but also your income, as we'll get to in a minute. For example, if you spend $50K a year, 7.5% equals $37.5K of a $500,000K portfolio, close to 3 years, but might be light depending on total portfolio size. Haven't told them that yet. Low yield, 1 to 2% drags on the returns and could be optimized for safety and slight income. And again, cash and equivalents in my current situation is how I do this. Bucket 2, 5% bonds and treasuries, still heavily tilted to treasuries, which are ultra safe but low yielding, 2 to 3% for short-term intermediate terms as of March 2025. And again, I'm locked into some intermediates that are at higher interest right now because I've been rolling into treasuries. Started with bills, now I've been into notes, and I'm in that 2 to 7 year note category. Nothing as long as 10 years in my treasury strategy. 51.5% US stocks and 5% international and 2.5% REITs is equity heavy, which is great for long-term growth, but risky if market dips early in retirement. I'm in my 9th year of retirement, DIY retirement, and again, I have a rising equity portfolio. I had closer to a 40-60 when I first retired, moved it to 50-50, then I moved it up to 60-40, and now I'm going to 70-30. Is this a risk? Not if my bucket strategy works to protect me against sequence of return risks. Low international and REIT allocations miss some of the diversification benefits. So here's what they recommend to optimize. And again, I haven't told them all the facts yet, so I'll breeze through this quickly. I'll keep a 3-bucket strategy and adjust allocations. Let's use percentages and general principles. Feel free to share more specifics for precision. Again, since I didn't give them a total portfolio yet, they're using percentages. 10% for a bucket 1, 35% target for a bucket 2, slightly up from the 33 it's currently at. Split it between treasuries and moving into more U.S. bonds. Bucket 3, trim to shift funds from bucket 1 and 2, still ample for long-term growth, and then it goes through the diversification. And then it gives you some detailed breakdown of cash and equivalents, money market ETFs like bill or short-term CDs. Does anybody use an ETF based on money markets? I have some treasuries that I've experimented with, like V-bill, but I haven't tried this one. Anybody? Treasuries, they suggest IEI, I have not heard of that one. It concentrates on iShares 3 to 7 year Treasury bond ETF. I'm going to come back to this in a future video. What do you favor? Individual bonds or bond funds and ETFs? It does have BIV, which is one of the bond funds that I've used in my current portfolio. Stocks, VTI, I'm there. 15% in international. I do use VXUS as one of my ETFs for international exposure. I admit that it's only about 5% right now. Do I want to go as high as 15%? I'm not sure. REITs, VNQ, it's one I've used before. I also use FREL for a REIT ETF. And I know right now I'm light in that. Part of my strategy is I've been reducing it in my tax deferred and waiting till I have room in my tax free for REITs. Here's why this works, and it gives some expected outcomes: 2 to 2.5% ultra low risk in bucket 1, 2.5 to 3.5% low risk in bucket 2, and in bucket 3, 6 to 8% return, moderate high risk. Overall portfolio gives me a 4.5 to 5.5% average return with risk tiered by bucket, which again is an approach I use. Questions for you. Can you give me a better sense of the spending needs and your rough portfolio size? And how happy are you with the 55% in equities? Do you prefer more or less? And again, it reminds me, Grok is not a financial advisor. Please consult one if you need one, is what I add. My plans include, and again, I just reiterated, if you haven't seen my prior Grok experiment, this is circumstances similar to what I shared there. $70,000 withdrawals from portfolio to supplement $40,000 pension, 2 years away from starting my Social Security at 70. Wife starts hers in 3 years at her full retirement age, and will collect $1,750 at her full retirement age. And again, if Grok is smart, he can calculate what my PIA is, because it'll be 50% of my PIA. My PIA is not what I will get at 70. Portfolio size is more than 1.5 million total. I do use VTI, VXUS, low-cost ETFs. Treasuries are usually individual bonds since I've been burnt by bond funds. Domestic bond is still in BIV and VTIP. I'm working towards a 70% equity, but that may wait for Social Security to kick in. Again, I'm not in a rush to do a 70-30 right away. I'm going to do it as my portfolio allows. Would you change asset classes in optimization? And do I need more international? Or am I okay following John Bogle's advice? And again, let's see what Grok does with that question. Thanks for the detailed update. This gives me a clear picture to refine your optimization within a 3-bucket strategy. Let's break it down with your specifics. Again, it reiterates what I told them just to make sure we've got it. Now it optimizes. Shows you the current position and the buckets. And it breaks down that it guesses I'm holding about $210,000 in cash and equivalents right now. I'm actually a little higher, and I am working to move some of bucket 1 into bucket 2 and bucket 3 in the future. It sizes the bucket 2, and again, it's still working on 6 years. My bucket 2 is really 5 years. And then bucket 3, it's going to suggest more international, I'm sure. It goes through the current situation and then goes to the optimization goals. Fund 210K for 3 years now, then adjust post Social Security. Covers 4 to 9 years, 420,000 now, less later. Favoring individual treasuries over bond funds. Build towards a 70% equity, over $1 million in bucket 3 gradually, balancing U.S. and international with Bogle's advice in mind. So let's see what it does. So it suggests money market funds. And again, I don't have a lot of money market funds. I have high yield savings accounts, checking accounts, in my taxable accounts. In my tax deferred accounts, I'm using Treasury T-bills, short-term Treasury T-bills, and short-term notes. The 2 years, 3 years are in my tax deferred account. If I have current year expenses in my bank, I worry about years 2 and 3 in a mixture of my taxable and tax deferred accounts. Goes through recommendations for individual treasuries, and this is exactly the strategy I've been pursuing, laddering 2 to 7 year treasuries, and I time them with new auctions as they come up and things are available. So I didn't do a ladder all at one time. I've been building the ladder, stacking things on top to give me the treasuries spread out. It recommends that I keep BIV and VTIP for now for inflation protection and slight yield. I can tell you I'm okay about breaking even on the VTIP, but BIV is still substantially down from the 2022 when we lost both on bonds and equity. Bucket 3, it recommends VTI, and it recommends VXUS, which are my principal ETFs in this front. REITs, it recommends doubling, and again, I plan to in my tax-free accounts. In the transition, it maps out a transition plan for that. Then it comes to the international stocks, Bogle versus your needs. John Bogle's advice, he famously advocated minimal international exposure, 0 to 20% of equities, arguing that U.S. markets are diversified enough via multinationals. For you, 5.5% international is 9% of bucket 3, within his range but low. Boosting to 15% makes sense. The pros, it diversifies. The cons, it's higher volatility, currency risk changes. The verdict, so 15% is a sweet spot, more than Bogle's minimum, but not overexposed. If you're staunchly Bogle, cap at 10%, reallocating to VTI. And that may be the strategy I look at doing. I may tweak my target portfolio with this suggestion in mind. Why this works? You've got a secure next 3 years, adjustable later, covers the intermediate with the treasuries to provide comfort, and bucket 3 is tilted towards long term. And again, comes through with the returns. Again, even fuzzier math here. Let's see. No new classes needed. More international is my tweak. Adjust to 10% if Bogle is your guru. He is. 58% equities now is moderate. 70% later is reasonable with your Social Security cushion. Your Social Security estimate, if yours is much higher or lower than 40K, let me know and I'll refine bucket 1 and 2. What do you think? So my estimate for Social Security at 70 will be $55,000 with the spouse's Social Security adding $21,000 when she files. And again, that's based on the spousal benefit topping her up. Does that change anything for bucket 1 and 2? Great. Thanks for the specifics. This boosts your post-Social Security income and reduces reliance on portfolio withdrawals, which does impact bucket 1 and 2. Let's update the plan. And it goes through and updates the plan. Here was the updated picture. Current optimization before that Social Security update. This is what it said. And here's what it revised for the strategy given the full set of facts that I've shared in my prior Grok experiment. So note the expenses here. If spending rises, e.g. 3% inflation, well, that's my current plan right now, is that we're stuck with 3% inflation for a while, then the portfolio will need to contribute $74K a year in year 1, $78K in year 2, and the year 3 withdrawal would be $23K after full Social Security kicks in, for a total of $175K for those bucket 1 3 years. Inflation protection is needed, and in bucket 2, I've been using 5-year tips to help provide some tips protection along with the V-tip in bucket 2. It notes this on the bucket 2. Post your wife's Social Security, that's year 4 plus, withdrawals could drop to 0 to 14K a year. Now, I don't know if Grok has heard of the term of required minimum distributions, but about this time, I'm going to start running into my distributions starting at the age of 73, and my wife will have RMDs at 75. But it occurs to me as I think about managing and optimizing my portfolio, RMDs may be simply moving from tax deferred to taxable, depending upon what we really need to spend. It's a change in mind when you're into retirement. So then it gives you an adjusted allocation. Given your higher Social Security income, you can reduce buckets 1 and 2 slightly now, and as withdrawals taper off quickly, here's a tweak, and it goes through some recommendations on what to do in bucket 1 and in bucket 2. And in bucket 3, it's still stressing that I should increase international stock holdings to 15%. Again, I'm more likely to stick with 10. And REITs, maybe up to 7%. I don't know. And then it makes some recommendations of selling some things, including selling some VTI. Maybe on a really up day, I can do some of that, selling VTI and putting more into VXUS. It depends upon market conditions on when I do that, though. I'll take a look at each quarter as I'm rebalancing to see which is the smart move to make. Does this change buckets 1 and 2? So with your Social Security in 2 years, the withdrawal needs go from about 70K to 15K. So 165K suffices versus the 210K for 3 years of 70,000K. Now, this is an important thing. I used to do this just on expenses, and if I'm running roughly 110 expenses, I put 110 times 3 into bucket 1. And recently, in my last iteration of my own DIY 3-bucket portfolio, I've reduced that to the 110 minus my pension. So as the Social Security rolls in, this is a valid point. Why this fits? It covers your 3 years waiting for Social Security, and in bucket 2, it easily funds what you need in bucket 2 and moves more into bucket 3, helping me reach the 70% faster. I will conclude with my standard warning. I have no initials after my name, so take these as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need one.